Welcome to the Daily Insights that matter. Despite facing some global headwinds, it's remarkable to see how resilient the Indian economy has been. However, there are two key issues that need addressing. Firstly, our rural economy is still in the process of recovering fully. And secondly, Indian companies have been quite hesitant when it comes to investing in capital expenditure. Regarding capital expenditure, it appears that the burden of heavy lifting falls on the government for investment. Nevertheless, there is a glimmer of hope as per the latest Economic Times report, which indicates that Indian companies are gradually increasing its capital expenditure. The report examined a sample of 373 constituents from the S&P BSE 500 index, and impressively, 3 out of every 4 companies in this sample reported a year-on-year improvement in gross fixed assets. In the fiscal year 22 to 23, the total gross fixed assets of the sample increased by 6.8 lakh crore, which translates to a 16% growth, reaching 48.9 lakh crore. Comparatively, the increase of the preceding year was 2.7 lakh crore. The key takeaways from this data suggest that India's corporate CAPEX spending is rising due to increasing cash flows and improved balance sheets. However, it's crucial to acknowledge that signs of a broad-based CAPEX cycle are still not entirely evident, primarily due to multiple uncertainties in the economic landscape. Nonetheless, once these headwinds subside, there seems to be great potential for India's capital expenditure to undergo a full cycle recovery. The positive indicators include strong bank and corporate balance sheets and infrastructure pushed by the Indian government, with investments in highway, railways and defense spending, all of which argue well for the economy. Additionally, the PLI scheme acts as another positive driver for domestic manufacturing alongside the government's push for energy transition. The China Plus One strategy also provides a fertile ground for the revival of the CAPEX cycle. In conclusion, while there are still uncertainties to navigate, the potential for a strong and comprehensive recovery in India's capital expenditure seems promising, driven by the factors we mentioned earlier. In a surprising turn of events, Jet Airways, the troubled and grounded airline, has received the Indian operator's permit to take to the skies again. Jet Airways, after flying for 25 years, had stopped operating in April 2019 after running into financial difficulties burdened with piling losses, debt and dues. The airline was then put under the insolvency resolution process by the NCLT, after which the Jal and Kal Rock Consortium emerged as a winning bidder in 2021 to revive the airline. The Jal and Kal Rock Consortium said it would spend a total of 1,375 crores, out of which 900 crores would be capital infusion and the remaining 475 crores would be paid to the creditors. However, no repayment has been made till date. The significant development was regarding the renewal of the Air Operator Certificate of Jet Airways from the DCGA, which is a regulatory body for aviation in India. The Air Operator Certificate is a license issued by the DCGA that allows an airline to operate flights. The renewal of the AOC paves the way for the grounded passenger carrier to revive its services in India. Moreover, it instills confidence of the Indian aviation regulator in the revival of Jet Airways. This will be the first time in the Indian aviation history that an airline is being revived after being grounded for an extended period. While the final rounds of hearing are due on August 7th, this significant development of AOC bodes well for the Jet Airways and the entire Indian aviation sector. With that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com